Let me get in Gautam Duggad, Head of Research at Motilal Oswal Institutional Equities. Gautam, always a pleasure to have you on the show. And I was just going through, your report, which looks at Q2, and you start by saying there is a reason for optimism. Now, this flies in the face of what a lot of analysts are saying. They're saying that maybe second half, but Q2 has been set up largely for a little bit more of pain. Why do you think differently?
So, Tawara, good morning. Thanks for having me. So, when we say Q2 is set for a little bit of optimism, it is in the context of the recurring downgrades in earnings that we've seen for the last 4 or 5 quarters. We think the base is now met for earnings. We don't expect any meaningful earnings downgrades from here on. Everyone understands September was a month of GST transition, so there are a couple of sectors which are going to get hit.
We seem to have lost that line. We'll try and get him back in a second, but just to tell you what they're saying. They're essentially saying the intensity of earning cuts has actually erased to modest levels, and the latest quarterly cuts have been the lowest in the past 4 quarters. So that's one of the reasons that there is some optimism there from Gautam. Gautam, can you hear us? I think our line got cut off.
Sorry, I think I lost for a couple of seconds.
No, it's okay. Please continue.
Because the intensity of earnings downgrades is moderating. Second, GST transition month, September, impacted many sectors, so market will look beyond that. More importantly, the cumulative impact of the steps taken by government and RBI, which is interest rate cut, GST cut, income tax cut, and then we had good infusion of liquidity for last 3-4 months, plus monsoon has been fairly good, and you have festive season, which has begun on a good note. So there is a hope that post first half, you will see earnings picking up a bit, which is what we are also building in. We are building in a 10% earnings growth for Nifty this year from the board. Last year was a very flattish year of about 1% Nifty EPS growth. And broader markets, we're expecting a slightly better growth at about 18 to 20% for our mid-cap universe. So that's what we mentioned when we said that there is a bit of a room for optimism, because last 4 or 5 quarters have been very, very abysmal in terms of the strength of earnings as well as the future forward revisions of those earnings.
Again, what is the fundamental reason why things should get better? Just because last 4 or 5 quarters have become abysmal and earning cuts are at the lowest level, is there any fundamental reason that you're seeing for the improvement in this quarter?
So I think, Tawana, you missed what I said. I said the cumulative impact of rate cut, income tax cuts, GST cuts, good infusion of liquidity, monsoon, festive season, all of them will cumulatively manifest in demand recovery in B2C sectors in India, right? And
the reason, Gautam, I heard you, but the reason I'm asking you again is, for example, look at what an HUL is saying. And HUL is coming out and saying that destocking is in a way hurting them. Till September, October, they don't know if this is going to help. And yes, down the line, it will help. But is this still going to be a period of transition in Q2?
So, Tawana, all of us are grappling with it. September was, that's why I mentioned, let me repeat it at the cost of, let me say it at the cost of repetition. September is a month of GST transition across sectors. We virtually lost the entire September. As the price changes land in the market and customers get accustomed to it, there will be some old inventory which will need clearance. New stocks will take some time. So there is going to be a few days here and there. Market will obviously look beyond that. I know you cannot get stuck on the fact that October first 20 days were bad, so therefore market is not looking good. Look at a bigger picture that there is a massive overhaul. Now, this is a very big change which has happened, and the kind of impact on prices that they're going to have will definitely result in some demand pickup. We have seen some semblance of evidence of that in auto sector. We will see that in other sectors as we go along. So someone who's looking beyond October, November, I'm sure a lot of people will invest at least with a 1-year horizon. So for them, whether it settles in October or November shouldn't matter much. On a full year basis, it is fair to now expect 8 to 10% kind of earnings growth for large cap Nifty 50 companies, and about 18 to 20% that we are currently penciling in for mid-cap universe that we cover, close to 100 stocks. And that's why I said that now 1-year market is consolidated. We are pretty much at the same level where we were on 27th September, which incidentally was the Nifty peak day. And on a 1-year basis, we have gone nowhere. Earnings have also gone nowhere. So it's quite fair to say that market has been quite reasonable, while going nowhere. So as things pick up, as you see more evidence, as you hear more corporate commentaries in October earnings season about demand picking up, I think markets will react to that.
Gautam, good morning. And actually, it's 430 days or slightly over 430 days that the index is at the same level that it was, right, as it is today. So it's quite a bit of consolidation. My question to you is, as I hear your answer, is that what's the kind of addition to your initial pre-GST estimates that has happened to earnings of, let's say, the consumption sector? Because I think that's the one that gets impacted the most with GST 2.0.
So, Neeraj, fair point, 430 days, maybe we will take 100, 150 days more, who knows. As far as numbers are concerned, we have raised our estimates for auto sector because that seems to be the single largest beneficiary of this GST regime. Luckily, we had upgraded auto sector in our model portfolio in July from underweight to overweight. That has helped us in the last 2 months because in August and September, auto has been among the best performers. So much so that now on a calendar year 25 basis, auto is the number one sector in terms of the index return. The auto index has done the best. Till August, it was banking index. So auto has clearly seen about 3 to 6% kind of earnings upgrade. We will see some upgrades happening in consumer discretionary and consumer staples as we go along. But analysts are, and rightly so, waiting for the commentary for the month of October before they actually pencil in those estimates. So from an overall markets point of view, because banks and IT are completely aloof from this GST change, and of course commodities too, so roughly 60-65% of the index earnings are not getting directly impacted by GST regime. It's largely sector specific, but sentiment, it will help the overall market. In terms of absolute numbers at an index level, I don't see any big change happening purely because of GST related changes. It will be sector specific and of course stock specific.
So therefore, headline Nifty 8 to 10% earnings growth that you mentioned, that stays the same, or has that seen a bump up because of GST 2.0?
No, not really. It has not seen any bump up because, Neeraj, as you are aware, we've also heard the H1B impact coming in for IT sector. Though the IT impact on the index is now fairly limited because the weight of IT in the index itself has shrunk from the mighty 20% 4 years back to just about 10% now. But even if IT sees 3-4% of earnings downgrade because of whatever steps that have been taken on H1B visa, it will at the margin take away 0.5 to 1% of the index earnings. So there are a lot of counterbalancing forces at play here. While you are seeing upgrades in auto, you might see some upgrade in other B2C sectors, but at the same time, IT is not helping the matters. And banks have been very, very tepid. In fact, I expect a marginal downgrade in the preview itself for banks. Incidentally, we published about 10 notes on banking sector in the last 10 days. So every day we have published one note on banking sector in the last 10 days. There have been a lot of, number related changes which might have happened in the bits and pieces. But on balance, I expect banking earnings to also see a moderate downgrade as we go into the preview.
Gautam, very quickly, short question though, which is the dark horse for Q2?
I think the dark horse for Q2 will be same as the Q1, which is cement, EMS, defense, these companies. Cement for sure, because everyone knows FY25 was very bad, and therefore when we made the projections for FY26, and because we split the year into 4 quarters right at the beginning of the year, so we had a visibility that all the 4 quarters for cement will look exceedingly good. Second, EMS, they continue to sprint at 50-60% growth, so that should continue. Defense should also have a reasonably good quarter in my view, and select consumer discretionary segments like hotels, jewelry, some of the apparel stocks, they might see, not necessarily apparel because apparel will get impacted by the GST transition, but yeah, hotel, jewelry, these are some of the discretionary names which should have a reasonably good quarter in our view.
Okay, I think the word is still out on what the consumer behavior is going to be. A lot of conflicting data coming in. Some data coming in that you have credit card spends going up. Some data coming in that after the 20-second boost, e-commerce spends are going down. So I think we'll wait and see what happens there. And I agree with you on the core changes that we have already seen. Those will take time to play out. Whether September or October doesn't really matter. Thank you so much, Gautam, for speaking with us today.